Let's welcome in Adrian Mowat, who's with us. Needs no introduction, veteran investor in emerging markets. Adrian, great to have you with us here on the program. Thanks for your time. We're not used to 2% down days. We've got one today. What's the big driver, in your opinion?
There are two things, and you already talked about some of these in the introduction. At the market fundamental level, we probably got ahead of ourselves in terms of US interest rate cut expectations, particularly as expressed in 10-year bond yields moving as low as 3.7%. The ADP report indicates that perhaps the non-farm payroll that will come out tomorrow morning US time will show a more robust number than we've seen in some of the more recent prints, perhaps something around 150,000. So remember about the context of this is that the economic bears are looking for the increase in the non-farm payroll to continue to narrow as indication of the economy slowing meaningfully. If the decline in the non-farm payroll increases, which is still quite high at 150, stays at this level, then that narrative looks weaker. So the interest rate cutting support for the market may be more modest than the market was expecting a week or so ago. Clearly, situations in the Middle East are escalating. You've had the President of the United States having to make a statement about whether the US would approve Israel attacking Iran's nuclear facilities. So I think just indicative of how rapidly this situation is escalating. We're seeing some impact in the oil markets as well. So we're seeing markets selling off after what has actually been a pretty decent September. Now, within emerging markets, as the gentleman from BlackRock then was indicating, we have got this rotation story where Chinese markets have stood on their tails and are moving up so rapidly that active fund managers who've been underweight China, overweight India, need to address that position. And it is worth highlighting that the Chinese equities that they're buying into are still very inexpensive despite the moves that we've had. And the level of policy support does look very significant. I think it is on par to Mario Draghi when he was heading the ECB, coming out of the GFC into the Euro crisis, indicating he'll do whatever it takes. And in doing whatever it takes, first thing you need to do is inflate the value of financial assets, so both equities and bond markets. That's very important at improving the collateral within the financial system, which takes some of the stress out of the balance sheet recession that's been building in China. So you can overthink this and think, oh, is this really going to fix the economic problems? Don't look at it that way. Look at it as the medicine is going to be good for the stock market. We can answer the economic story a little bit further on. So short term, I think India is under particular pressure because it's been a terrific market, a long-term bull market, big outperformer. Positioning is bullish there with foreign investors. They need to sell some of that to buy some in China in order to reduce their underweight, reduce the pain that they're experiencing in underperforming a rallying China.
Adrian, hi. Thank you for joining in. You've laid out the various moving parts that impact the global markets and macros very beautifully, whether it's, what happens in terms of Fed rate cuts, the Middle East conflict. But the question is, how does one price in the Middle East conflict? Because there are huge implications for markets like India, the way crude behaves. So when you look at the short to medium term, you spoke about how India has been an outperformer, the overweight positioning is there when it comes to investors. But how would you price in the Middle East conflict from here on? How does it play out in your base case?
It's always very difficult. Generally, the story with geopolitical events is there a short-term impact on markets. Now, what you've then got to caveat that statement and look at more recent events, such as Russia's invasion of Ukraine, that caused quite a significant energy shock, particularly in the European community, where the price of gas went up dramatically, which hit the price of electricity. And then you had a fundamental impact which needed to be priced in. I think the issue with crude oil is that it's a very fungible asset, an easily moved asset. It's not like gas, which requires pipes degasification if you're using LNG. So I think you probably might see a temporary spike in the oil price as the fundamental factor here, even if this is to escalate a bit further. So definitely risk premiums will rise near term. Whether it has a medium-term fundamental impact, I'm not so sure.
Adrian, hi, great to have you on the show. And you make that really interesting point. And I think we started this debate right when the Chinese market did that, recoil spring effect as it completely started pole vaulting, 24% up on Hang Seng in the last 1 month. The question is how much more FPI selling? Because anyway, foreign investors have been largely underweight or neutral in best case on India for a long time. So perhaps we're talking about funds or passively or actively managed funds which already have positions and are booking profit. Are you expecting this to really increase in a more meaningful manner? And if that happens, would you expect that whole wave of domestic liquidity to still support the market? I mean, the Nifty is down only 4% from the peak. What do you see ahead in the coming few months?
So my understanding of the positioning of active managers is they are overweight, which is a good place to be because India has been a significant outperformer. It is about a quarter of the EM benchmark these days. So if you wanted to outperform as an active manager, you needed a big exposure to India. And you wanted to be very underweight China because up until about 30 days ago, or even actually 14 days ago, being underweight China was the smart move to have. So I do believe that active managers are overweight India and they're having to sell down where they're overweight in order to find cash to put into the China market. So India is the wrong side of that flow story. Now, it's always difficult to measure the overall size of these positionings. We do get some data from the ETF markets about the positioning of active funds, but it's relatively limited.
Hi, Adrian. Good afternoon and good to see you in. So you're pretty clear on that. Since fund managers were overweight India, maybe taking some money off the table and deploying some money into the Chinese market. But with regard to the Chinese market pop that we've seen it before, right? In the last couple of years, we have seen them bounce up and then those markets give it away. Do you think this time around the measures that have been announced are good enough to hold the economy in good stead and in turn boost up the stock market as well? Or do you believe that again, it could possibly fizzle away?
So I think we need to phrase it the other way around, that you need to push up the value of financial assets to help the economy. So if your test is, I need to see the economy being better, then don't bother buying China because you'll have missed the rally. So I think the level of policy support this time is very significant. So if we think about the other rallies that we've seen in China, we had a rally in China early in the COVID story because their zero COVID policy did allow them to basically open up the domestic economy. And the Chinese equity markets did extremely well in 2020. You had a sharp rally in late 22, early 23 on the opening up story, but there wasn't any real policy support beyond the opening up. If we go back to a market like the US market, the US economy is opening up in 2021, 2022, and the US government's providing very significant fiscal support. So I think the way to look at it this time is the Chinese policy makers realize that they have a serious structural issue, and this requires dramatic policy action, both in the monetary field as well as the fiscal field. And I think the monetary policy is quite innovative. When we look at what's going on with how they're supporting the housing market, making sure the banks have got a bit more capital to play with, these all look like smart, innovative things. And remember, they're doing it against a backdrop of deflationary pressures, which does give central banks a lot more flexibility. If you're not worried about inflation, if you're worried about deflation, we know how innovative central banks can be. And I go back to that Mario Draghi ECB analogy, which was a very, very significant event for capital markets and resulted in many years of risk assets doing well.
Absolutely, whatever it takes. How can we forget those big, lofty words? That was a phrase that became, I think, capital market history, right? Adrian, but just to go back to the point on India, you explained why the shift is happening, active managers selling down a bit of India and maybe moving that money to China. But the second part of my question was how much more? The Indian market hasn't seen a meaningful correction in, I don't know how long, I think 2-3 years since COVID. So what sort of a correction would you expect in India? And would you be advising to buy the dip?
So firstly, I'm not aware of any significant negative delta on the local fundamentals of the Indian economy. I think we've continued to got inflation coming down, economic growth is robust. There's maybe a modest negative story in that the oil price is moving up, but it's moving up from an extremely low level. And that the Indian bull market has been driven, as you've indicated earlier, by local investors, not by foreign investors. So I think if there is a correction in the Indian market because of the events we're talking about, it is a little bit of pressure from foreign selling and local investors concerned about the geopolitical risks rising. So I would view it as being a modest correction. And, there's nothing wrong with a bit of a correction in what has been a very powerful bull market. At best, you're sort of up 20+% year to date. I think it's moderated to around 16 as I look at the sort of international indices. But I think that's fine. Maybe another 5% to go. But I don't see anything in the Indian fundamentals justifying a more dramatic sell-off.
Just a couple of rapid-fire ones, Adrian, if you're up for it. You said a couple of times the stimulus in China seems to be very big, but we've not really heard anything concrete, right? Essentially, it's media reports still, international media. On the monetary side, what got people excited is fiscal. And there, those numbers of 2 to 3 trillion renminbi, I mean, that is still in the realm of sort of news reports, etc.
So what we have so far is a lot of statements from the PBOC, and the PBOC has been criticized for not doing enough considering the deflationary forces that are in place. And so the actions in terms of pushing capital into the financial system, both into brokers, into banks, providing capital for SOEs to buy property and take this excess property supply and turn that into government social housing, where there is a chronic shortage of housing for the lower income groups in China. These are all quite significant statements. So from what I see at the monetary level, and I use the monetary level in terms of what the PBOC is allowing to happen, I think those are very significant. We do expect further fiscal policies. Although China's fiscal position is currently very supportive, it has quite a high fiscal deficit already, but I would expect more from the government there. But this, to me, I go back to the ECB, Mario Draghi analogy. It's what the central bank is doing. And remember, it's again, powerful analogy. The ECB was heavily criticized for being very slow in the GFC. They were putting up interest rates as we were beginning to see the subprime housing crisis build in the United States. They were slow to appreciate the deflationary pressures. They were slow to appreciate the pressure that was on the peripheral bond markets in Spain, in Greece, even to some extent in Italy. And then eventually Mario Draghi came in and he got that they had to do something dramatic. So we have a central bank that was viewed to be very behind the curve, and it's come through with what looked like dramatic measures, certainly relative to what we've been seeing from them in the past.
Adrian, just a quick word on India then, back to India. Are investors concerned about SEBI tightening the F&O regulations? Have you picked up anything on that?
I haven't, but when you're watching some share prices go up 25% in the day in China, sometimes you miss the small print from SEBI.
Okay, all right. We'll leave it there, Adrian. Great conversation. Appreciate you joining in. And it's a good chat, and hope you'll sort of join us over the next couple of days as well as we continue to track this. I mean, the big move in sort of Chinese equities via, of course, Hong Kong listed securities for now this week because China is shut, and of course what's happening here in India. We'll take a very